Hey everyone, and welcome to the Bamboo Brief. So, Netflix just dropped its Q3 earnings, and bam, the stock took an immediate hit. Now, on the surface, this looks like bad news, but trust me, the real story here is way more interesting. Let's break it all down.
So here's the puzzle, right? On one hand, all the headlines were screaming earnings miss, but on the other, the company posted some seriously fantastic revenue growth. So what gives? We're going to unpack what really happened, why the market reacted so quickly, and what this actually means for Netflix going forward.
All right, first up, let's tackle what caused all the drama in the first place, that sudden drop in the stock price.
Okay, check this out. Revenue. It came in exactly as the analysts predicted, a whopping $11.5 billion. Pretty solid. But, and this is the big but, the earnings per share, or EPS, tells a totally different story. Wall Street was looking for $6.97, and Netflix delivered $5.87. That's a pretty significant miss, and it's what got everyone's attention.
And the market's reaction? Oh, it was fast. In after-hours trading, the stock tumbled about 7%. I mean, this is that classic knee-jerk reaction you see with an earnings miss. But the real question we need to ask is, why did they miss?
Well, it turns out this entire earnings mess wasn't because the business is struggling or growth is slowing down. Nope. It all came down to a single, kind of random item. The culprit was something called a Brazilian tax provision. Now that sounds super complicated, but it's actually pretty simple. It's just a one-time charge from a legal thingy over taxes in Brazil. The key words to focus on here are one-time and non-recurring. This isn't a problem with their main business of making great shows, it's just an accounting headache. And don't just take my word for it. The company's own CFO, Spence Neumann, said it himself. He basically said that if you take out this one-off expense, Netflix would have actually beaten their forecast. And he doesn't expect it to be a problem in the future. So the takeaway is crystal clear. The actual business is doing just fine.
And speaking of that business, let's pivot and look at the real story here, which is just how incredibly strong the company's performance actually was when you look under the hood.
Let's start with this number, 17%. That is some seriously impressive year-over-year revenue growth, especially for a company as huge as Netflix. It just goes to show their global strategy is absolutely working.
That growth added up to a staggering $11.51 billion in revenue for just one quarter. That's a testament to their massive scale and just how consistently they perform.
Now, what's really exciting for the future is this. The company reported its best ad sales quarter ever. Their newer, cheaper ad-supported plan isn't just bringing in new subscribers, it's quickly becoming a major moneymaker all on its own. That, my friends, is a huge win.
So the present looks great, but what about the future? Well, for Netflix, content is king. And let me tell you, their upcoming pipeline is absolutely stacked.
I mean, just look at this lineup. You've got guaranteed blockbusters like the final season of Stranger Things and the next Knives Out movie. Then you have critically acclaimed hits like The Diplomat coming back. This is the kind of stuff that keeps people subscribed and brings in millions of new viewers.
But here's the thing, for long-term growth, it's not just about sequels. You have to create brand new original hits. You have to build the franchises of tomorrow. And boy, have they just proven they can do that in a massive, massive way. Let's talk about K-pop Demon Hunters. This animated movie is now Netflix's most watched film of all time, with over 325 million views. But it is so much more than just a movie. They've already signed major toy deals, it's coming back to theaters, and they're blowing it up into a full-blown franchise with live events and books. This is how you build real long-term value.
Okay, so let's bring this all home. After all that, what does this actually mean for you, the investor?
The most important lesson here is this. You have to look past those scary headlines. The stock dropped because of a one-time accounting quirk, but the core business, we're talking revenue growth, ad sales, and their content machine is firing on all cylinders. Understanding the why behind the numbers is literally everything.
And hey, if getting insights like this makes you want to take action, you should definitely check out the Bamboo app to start investing today. If you use the referral code in the description, it's a really great way to support the channel, and I'd appreciate it.
If you found this breakdown helpful, do me a favor and smash that like button and subscribe for more content just like this. And of course, we'd love to hear what you think down in the comments.
So I'll leave you with this question. After seeing the real strength of the business hiding behind that headline, does this short-term dip look like a buying opportunity to you? Let us know what you think in the comments below. Thanks so much for watching the Bamboo Brief.